Right now, financial markets appear calm. Indexes remain near historic highs. Volatility feels unusually contained. And the dominant belief among investors is that any future downturn will be manageable. This sense of confidence is not unusual. In fact, it is one of the most consistent conditions present before every major market collapse in modern history. This is not a prediction. It is an observation rooted in patterns that have repeated across decades. The specific assets change, the narratives evolve, the technologies improve, but the underlying structure of market behavior remains remarkably consistent. Periods of sustained optimism tend to produce environments where risk is systematically underestimated, leverage increases quietly, and vulnerability builds beneath the surface. Before the crash of 1929, the prevailing belief was that industrial progress and economic efficiency had permanently reduced the likelihood of severe recessions. Productivity gains were strong, corporate profits were rising, and stock ownership was expanding rapidly among the general public. Newspapers spoke confidently about a new era of prosperity. Few questioned whether asset prices had moved too far ahead of economic fundamentals. Margin debt surged to record levels as investors borrowed heavily to amplify returns. Buying stocks with borrowed money became socially acceptable, even encouraged. As long as prices continued to rise, leverage appeared harmless. In reality, it was transforming the market into a fragile system that depended entirely on continued confidence. When selling pressure finally emerged, it was initially dismissed as a temporary correction. Many believed the decline would create a buying opportunity. Instead, falling prices triggered margin calls, forcing leveraged investors to liquidate positions. Liquidity evaporated. Confidence collapsed. Within weeks, the market entered a downward spiral that erased nearly 90% of the Dow Jones Industrial Average over the following years. The crash of 1929 was not caused by pessimism. It was caused by excessive optimism colliding with mathematical limits. Investors were not wrong about innovation or growth. They were wrong about valuation, leverage, and risk. Decades later, a similar structure reappeared during the technology boom of the late 1990s. The narrative had changed, but the psychology was identical. The internet was viewed as a revolutionary force that rendered traditional valuation models obsolete. Companies with no profits, no cash flow, and in some cases, no revenue were valued at billions of dollars. Analysts argued that growth potential justified any price. Capital flowed disproportionately into a narrow group of technology stocks. Initial public offerings doubled on their first day of trading. Retail investors entered markets aggressively, driven by fear of missing out rather than long-term strategy. Valuation metrics that had guided investment decisions for decades were dismissed as outdated. Again, warning signs were present. Price-to-earnings ratios reached extreme levels. Market concentration increased. Volatility declined as optimism became self-reinforcing. Investors interpreted rising prices as confirmation that risk had been reduced. When reality intervened, the adjustment was severe. From March 2000 to October 2002, the Nasdaq Composite lost nearly 78% of its value. Thousands of companies disappeared entirely. The few that survived were businesses with real cash flows and sustainable models. The broader market suffered years of lost returns. The lesson was not that technology lacked value. It was that paying any price for future potential produces fragile outcomes. Growth does not eliminate risk. It amplifies it when expectations become unrealistic. The global financial crisis followed the same pattern, though the mechanics were more complex. In the years leading up to 2008, credit expanded rapidly across the global economy. Mortgages were issued to borrowers with limited ability to repay. Financial institutions packaged this debt into securities that were rated as safe and sold globally. The prevailing belief was that diversification and financial engineering had eliminated systemic risk. Models suggested that housing prices would not decline nationally. Banks operated with thin capital buffers, assuming liquidity would always be available. Risk was not removed, it was redistributed and obscured. As housing prices rose, defaults remained low, reinforcing the illusion of stability. Leverage increased throughout the system. When housing prices stopped rising, the structure began to unravel. Losses initially appeared contained. That assumption proved catastrophic. Confidence evaporated. Interbank lending froze. Major institutions failed or required government intervention. Global markets experienced one of the most severe contractions in history. Trillions of dollars in wealth vanished. Central banks were forced to intervene on an unprecedented scale to prevent total collapse. Across these events, a consistent pattern emerges. Crashes are preceded by periods of calm. They are fueled by narratives of permanence. They are accelerated by leverage. And they are intensified by the collective belief that traditional limits no longer apply. What makes these patterns dangerous is that they are rarely obvious in real time. Most participants do not recognize them as they form. Instead, warning signs are interpreted as temporary noise. Elevated valuations are justified by low interest rates. Rising debt is framed as efficient capital allocation. Concentration risk is dismissed as a reflection of superior innovation. History shows that when multiple justifications are required to defend current prices, fragility increases. Markets do not collapse because participants are wrong about everything. They collapse because they are wrong about the margin of safety. The concept of margin of safety has been emphasized by long-term investors for decades. It refers to the buffer between price and underlying value. When that buffer disappears, even small errors in expectations can produce large losses. Periods of extreme optimism tend to coincide with the thinnest margins of safety. Another recurring feature is the compression of risk premiums. Investors accept lower compensation for taking on greater risk, believing that stability will persist. This behavior is reinforced by recent performance. If volatility has been low for years, it feels reasonable to assume it will remain low. But volatility is not eliminated by belief. It is deferred. As markets rise, volatility often declines. This creates a feedback loop. Lower volatility encourages leverage. Leverage amplifies returns. Amplified returns attract more capital. Over time, the system becomes dependent on continued stability. At that point, stability itself becomes the primary risk. This dynamic is not limited to equities. It appears in real estate, credit markets, commodities, and currencies. The asset class changes, but the structure remains. Confidence builds gradually and collapses suddenly. One of the most misunderstood aspects of market crashes is timing. Patterns do not tell us when a crash will occur. They tell us when conditions become vulnerable. Vulnerability does not imply immediate collapse. It implies sensitivity. In sensitive systems, small shocks can produce large outcomes. This distinction is critical. Many investors look for precise signals or dates. History does not provide them. Instead, it provides context. It shows that when valuations, leverage, and psychology align in certain ways, outcomes become asymmetric. Upside becomes limited while downside expands. At those moments, markets do not need catastrophic news to fall. They simply need less good news than expected. Disappointment, not disaster, is often enough to trigger repricing. Narratives play a central role in this process. Every major boom has a story that explains why the current environment is fundamentally different from the past. These stories simplify complexity and provide emotional comfort. They allow investors to ignore inconvenient data. Over time, narratives replace discipline. Valuation models are adjusted. Risk frameworks are relaxed. Past crashes are dismissed as irrelevant. This is not accidental. It is a psychological response to prolonged success. The most dangerous phase of a cycle is not panic. Panic occurs after losses have already materialized. The most dangerous phase is complacency. Complacency emerges when protection is no longer valued and risk is assumed to be controlled. Markets do not crash because people expect them to crash. They crash because expectations are too optimistic relative to reality. When expectations adjust suddenly, prices follow. This pattern has repeated across generations, technologies, and regulatory regimes. It does not depend on a specific asset or policy. It emerges from the interaction between human behavior and financial systems. Understanding this does not provide certainty. It provides perspective. Perspective allows investors to recognize when risks are being underpriced and when confidence has outpaced evidence. In the next part, the focus will move from historical patterns to measurable indicators that tend to appear late in market cycles. These indicators do not predict timing. They highlight sensitivity. They help explain why markets that appear strong can, under certain conditions, become unstable with surprising speed. History makes one fact clear. Every major market crash was preceded by a period in which risk felt manageable, narratives felt convincing, and caution felt unnecessary. The pattern is not fear. The pattern is confidence. As market cycles progress, the transition from stability to vulnerability rarely announces itself clearly. Instead, it becomes visible through a series of measurable signals that tend to appear repeatedly near the later stages of major expansions. These signals are not alarms. They do not indicate imminent collapse. Rather, they reveal how sensitive the system has become to change. One of the most consistent indicators is valuation. Across history, major market peaks have coincided with valuation metrics that move far above long-term averages. This does not mean markets must crash immediately when valuations are elevated. It means future returns become increasingly dependent on perfect conditions. Price-to-earnings ratios, price-to-sales ratios, and market capitalization relative to economic output have all demonstrated this behavior. When these measures reach extreme levels, markets are effectively pricing in sustained growth with minimal disruption. Any deviation from that expectation introduces risk. Before the crash of 1929, stock prices had risen far faster than corporate earnings. In the late 1990s, technology stocks traded at multiples that assumed decades of uninterrupted growth. In 2007, housing prices relative to income reached historic extremes. In each case, the valuation environment reduced the system's tolerance for surprise. Another recurring signal is the expansion of debt relative to income. Debt itself is not inherently dangerous. It allows capital to be deployed efficiently and enables economic growth. Problems arise when debt grows faster than the capacity to service it. Late cycle environments are often characterized by rising leverage across households, corporations, and financial institutions. Borrowing becomes normalized. Low interest rates create the perception that debt is inexpensive and manageable. As long as asset prices rise, debt appears sustainable. History shows that this perception can change quickly. When asset prices stagnate or decline, leverage magnifies losses. Cash flows that once appeared sufficient become strained. Forced selling emerges, accelerating price declines and tightening financial conditions. Credit spreads provide another useful lens. In healthy markets, investors demand compensation for bearing risk. As cycles mature, that compensation often compresses. Investors accept lower yields for riskier assets, believing default probabilities are low and liquidity will remain available. Before major crises, credit spreads tend to narrow to unusually tight levels. This reflects confidence, not safety. It indicates that risk is being priced optimistically. When conditions change, spreads widen abruptly, and assets reprice rapidly. Liquidity itself is another critical factor. In stable environments, markets feel liquid. Assets can be bought and sold easily with minimal price impact. This liquidity, however, is often conditional. It exists as long as participants are willing to transact at prevailing prices. In stressed environments, liquidity can disappear, buyers step back, sellers overwhelm demand, prices gap lower. This dynamic was visible in 2008 when markets that had appeared deep and liquid froze almost overnight. Late cycle periods often feature a false sense of liquidity. Trading volumes remain high, but they are supported by leverage, passive flows, and short-term strategies. When confidence erodes, these sources of liquidity retreat simultaneously. Market concentration is another repeating signal. As cycles mature, returns become increasingly driven by a smaller number of assets. Investors crowd into perceived winners. Capital allocates towards scale, momentum, and familiarity. This concentration creates vulnerability. When a narrow group of assets supports overall market performance, weakness in those assets can have disproportionate effects. Diversification appears effective until correlations rise, at which point it offers limited protection. Behavioral indicators also matter. Late in cycles, investor psychology shifts subtly. Caution is reframed as pessimism. Risk management is viewed as unnecessary. Leverage is justified by recent success. Media narratives tend to reinforce this behavior. Stories emphasize innovation, efficiency, and structural change. Historical comparisons are dismissed. Warnings are portrayed as outdated or alarmist. This environment encourages participation from less experienced investors. Retail activity often increases near peaks. New products promise easy access to returns. Complexity is marketed as sophistication. The combination of leverage, concentration, compressed risk premiums, and optimistic narratives produces a system that functions smoothly until it does not. When conditions change, feedback loops emerge. A decline in asset prices reduces collateral values. Reduced collateral triggers margin calls. Margin calls forced selling. Forced selling pushes prices lower. This loop accelerates stress. Central banks often attempt to counter these dynamics by providing liquidity. In many cases, these interventions stabilize markets. However, they can also contribute to future vulnerability by reinforcing risk-taking behavior. When participants come to believe that policymakers will always intervene to prevent losses, risk tolerance increases. This phenomenon, sometimes described as moral hazard, encourages leverage and speculation. Over time, markets adapt to these interventions. Each cycle requires larger responses to achieve the same stabilizing effect. This does not eliminate risk. It shifts it forward. Another important element is the mismatch between short-term incentives and long-term stability. Asset managers are often evaluated on relative performance over short horizons. This encourages behavior that aligns with prevailing trends rather than fundamental analysis. When markets rise, underexposure carries career risk. This dynamic leads managers to remain invested even when valuations appear stretched. The result is collective exposure to the same risks. Derivatives and structured products can amplify these dynamics. While designed to manage risk, they can concentrate it under certain conditions. When volatility rises, hedging strategies can require selling underlying assets, exacerbating declines. These mechanisms are not inherently flawed. They function effectively in stable environments. Problems arise when assumptions about volatility and liquidity break down. Importantly, none of these indicators operate in isolation. Valuation extremes alone do not cause crashes. Debt levels alone do not trigger collapse. It is the interaction of multiple factors that creates fragility. This interaction increases nonlinearity. Systems behave normally until they reach thresholds. Beyond those thresholds, responses become disproportionate. Small changes produce large outcomes. History demonstrates that markets can absorb negative information for extended periods. Vulnerability builds quietly. The eventual adjustment often appears sudden because the preceding tension was invisible. Timing remains uncertain. Indicators can persist for years before repricing occurs. This is why predictions based solely on valuation or debt often fail. The system can remain unstable longer than expected. However, the presence of these indicators alters the risk profile. Upside becomes incremental. Downside becomes nonlinear. At that stage, outcomes are shaped less by fundamentals and more by positioning and psychology. Investors who understand this distinction focus not on predicting outcomes, but on managing exposure. They recognize that late cycle environments reward discipline rather than aggression. Throughout history, those who survived major downturns were rarely the ones who timed exits perfectly. They were the ones who avoided excessive leverage, maintained diversification, and respected uncertainty. The most damaging losses tend to occur when investors assume stability is permanent. When protection feels unnecessary, it is often most valuable. Markets do not require widespread panic to decline. They require reassessment. When reassessment occurs in highly leveraged, concentrated systems, adjustments can be abrupt. In the next part, attention will turn to long-term debt cycles and how prolonged expansions create structural imbalances. These imbalances do not determine timing, but they shape the severity of outcomes when adjustments occur. Understanding these dynamics is not about fear. It is about recognizing patterns that have repeated across generations. History does not repeat exactly, but it often rhymes. The same forces that produced past booms and busts continue to operate today. Technology evolves, policy changes, human behavior remains remarkably consistent. Recognizing late cycle indicators does not require pessimism. It requires awareness. Awareness allows participants to make informed decisions rather than reactive ones. As history has shown repeatedly, the greatest risks emerge not when markets appear weak, but when they appear strongest. That is when assumptions go unchallenged and buffers disappear. The pattern is not collapse itself. The pattern is the gradual build-up of sensitivity. When sensitivity reaches certain levels, outcomes become unpredictable. This is why markets that appear stable can change rapidly, not because conditions suddenly worsen, but because the system's ability to absorb change has diminished. In the next section, this framework will be applied to the concept of long-term debt cycles and how they influence asset prices, economic growth, and financial stability over extended periods. To fully understand why markets become increasingly fragile late in cycles, it is necessary to step back and examine the role of long-term debt cycles. These cycles operate over decades, not years, and they shape the underlying structure of financial systems in ways that are not always visible during periods of expansion. Debt cycles begin innocently. Credit expands to support productive investment. Businesses borrow to grow. Consumers borrow to smooth consumption. Governments borrow to fund infrastructure and public services. When managed responsibly, debt can enhance economic growth and stability. Over time, however, debt accumulation tends to outpace income growth. This is not the result of a single decision, but of repeated incentives that favor borrowing over restraint. Low interest rates reduce the apparent cost of debt. Rising asset prices provide collateral. Success reinforces confidence. As debt grows, economies become increasingly sensitive to changes in interest rates, liquidity, and confidence. Early in the cycle, this sensitivity is manageable. Late in the cycle, it becomes a defining feature. One of the most important characteristics of long-term debt cycles is that they mask risk during periods of stability. As long as cash flows are sufficient to service obligations, debt appears harmless. Problems emerge when conditions shift, even modestly. Historically, long-term debt cycles have ended in one of two ways, either through prolonged periods of deleveraging, where growth slows and debt is gradually reduced, or through abrupt adjustments involving financial crises, defaults, and policy intervention. In the decades following World War II, many advanced economies experienced sustained growth supported by expanding credit. Financial systems deepened, capital markets grew, leverage increased. These developments contributed to prosperity, but also laid the groundwork for future instability. By the late 20th century, financial innovation accelerated this process. New instruments allowed risk to be repackaged, distributed, and obscured. Leverage became embedded not only in balance sheets, but in market structures. Derivatives, securitization, and leverage-based strategies allowed participants to amplify returns while appearing diversified. In stable environments, these strategies performed well. In stressed environments, they transmitted shocks rapidly. The global financial crisis illustrated this dynamic vividly. Debt had accumulated across households, corporations, and financial institutions. When asset prices declined, the system lacked sufficient buffers to absorb losses without widespread disruption. Policy responses prevented a complete collapse, but they did not eliminate the underlying dynamics. Instead, they altered the path of adjustment. Interest rates were lowered to historic lows. Central bank balance sheets expanded dramatically. Liquidity was injected to stabilize markets. These actions succeeded in restoring confidence, but they also extended the debt cycle. Low rates encouraged further borrowing. Asset prices recovered and exceeded previous highs. Leverage remained elevated. Over time, this created a new equilibrium characterized by high debt, low yields, and increased dependence on policy support. In such environments, small changes can have outsized effects. When interest rates rise even modestly, debt servicing costs increase across the system. When liquidity tightens, refinancing becomes more difficult. When confidence weakens, risk premiums expand. Late in debt cycles, the margin for error narrows. Growth becomes more reliant on credit expansion. Productivity improvements alone are insufficient to sustain momentum. Policymakers face difficult trade-offs. Raising rates risks destabilizing leveraged sectors. Keeping rates low risks misallocating capital and inflating asset prices. Fiscal policy faces similar constraints as debt burdens grow. These constraints do not guarantee crisis. They increase sensitivity. Systems with high debt and compressed risk premiums respond more sharply to shocks. Another important feature of long-term debt cycles is the interaction between public and private balance sheets. When private sectors deleverage during downturns, governments often increase borrowing to stabilize economies. This transfer of debt can prevent immediate collapse, but shifts obligations to the public sector. Over time, public saw debt rises, future policy flexibility diminishes. In many advanced economies today, public debt levels are significantly higher than historical averages. This limits the ability to respond to future downturns using traditional tools. When both private and public sectors carry high debt, options narrow, adjustments become more complex, trade-offs become more pronounced. Inflation is one potential mechanism for reducing debt burdens. By increasing nominal incomes relative to fixed obligations, inflation can erode real debt values. However, inflation introduces its own risks and uncertainties. Deflation, by contrast, increases real debt burdens and can exacerbate downturns. Managing between these outcomes is challenging, particularly in highly leveraged systems. Throughout history, long-term debt cycles have often concluded with some combination of restructuring, inflation, financial repression, or policy intervention. The specific mix varies, but the underlying objective remains the same: restoring balance between debt and income. These processes are rarely smooth. They involve periods of volatility, redistribution of wealth, and changes in market leadership. Assets that perform well during expansions may struggle during adjustments. Another recurring pattern late in cycles is the reliance on extrapolation. Recent trends are projected forward indefinitely. Growth rates are assumed to persist. Risks are assumed to remain contained. This extrapolation affects not only investors, but policymakers and institutions. Forecasts become anchored to optimistic scenarios. Contingency planning is deprioritized. When outcomes deviate from expectations, adjustments can be abrupt. Plans based on stability must be revised quickly. Markets reprice uncertainty. Behavioral dynamics intensify these effects. Loss aversion causes participants to delay recognition of changing conditions. Confirmation bias reinforces existing beliefs. Social proof encourages conformity. As long as prices remain high, these biases remain unchallenged. When prices fall, they reverse rapidly. Fear replaces confidence. Liquidity evaporates. One of the most important lessons from past cycles is that vulnerability accumulates gradually and reveals itself suddenly. This creates the illusion that crashes are unpredictable, when in reality their preconditions are often visible in hindsight. Long-term debt cycles also influence asset correlations. During expansions, diversification appears effective. Different assets respond to different drivers. Late in cycles, correlations tend to rise. When leverage unwinds, assets that were previously uncorrelated can decline simultaneously. This reduces the effectiveness of diversification at precisely the moment it is most needed. Risk models based on historical volatility often fail during these periods. Past stability understates future risk. Assumptions break down. This does not imply that markets are destined to collapse. It implies that risk is nonlinear. Small changes in conditions can produce large responses. Understanding long-term debt cycles provides context for this nonlinearity. It explains why markets that appear robust can become fragile without obvious warning. It also highlights the importance of flexibility. Systems with greater buffers, lower leverage, and diversified exposures tend to weather adjustments more effectively. Throughout history, periods of greatest optimism have often coincided with late stages of debt cycles. Confidence masks fragility. Stability conceals imbalance. This pattern does not depend on specific technologies, policies, or personalities. It emerges from structural incentives and human behavior. In the next part, the focus will shift to market psychology and behavioral dynamics that dominate late cycle environments. These forces determine how participants respond to information, how narratives form, and how turning points accelerate. Understanding psychology is critical because markets are not machines. They are social systems. Prices reflect beliefs as much as fundamentals. When beliefs change, prices follow. When beliefs are deeply entrenched, change can be abrupt. The combination of high debt, compressed risk premiums, and optimistic psychology creates environments where markets are resilient until they are not. History suggests that the most important skill in such environments is not prediction, but preparation. Recognizing patterns allows participants to navigate uncertainty rather than deny it. Long-term debt cycles remind us that growth built on expanding leverage carries consequences. These consequences may be delayed, but they are rarely avoided entirely. As cycles mature, the question is not whether adjustment will occur, but how it will unfold and who will be most exposed. The next section will examine how investor psychology amplifies these dynamics and why late cycle behavior often appears rational until it abruptly reverses. As market cycles approach their later stages, psychology begins to dominate outcomes more than fundamentals. This shift is subtle and often misunderstood. It does not mean that data becomes irrelevant. It means that interpretation of data becomes distorted by expectation, emotion, and collective behavior. Investor psychology tends to follow predictable patterns. Early in expansions, skepticism dominates. Participants remain cautious, shaped by memories of the previous downturn. As markets rise and recover, confidence grows. Success is attributed to skill. Risk-taking is rewarded. Over time, caution fades. Late in cycles, optimism becomes embedded. Market participants expect favorable outcomes, not because they are certain, but because they have become accustomed to them. This habituation reduces sensitivity to warning signs. Information that contradicts prevailing narratives is discounted or ignored. One of the defining features of late cycle psychology is confirmation bias. Investors seek data that supports existing beliefs and dismiss data that challenges them. Positive developments are emphasized. Negative developments are reframed as temporary or irrelevant. This bias is reinforced socially. As more participants adopt similar views, dissent becomes uncomfortable. Contrarian perspectives are marginalized. Herd behavior intensifies. Media plays a significant role in amplifying this dynamic. Headlines reflect prevailing sentiment. During late-stage expansions, stories emphasize resilience, innovation, and opportunity. Risks are downplayed. Warnings are often framed as pessimistic or outdated. This environment encourages overconfidence. Investors underestimate uncertainty and overestimate their ability to respond to change. The belief that exits will be orderly and liquidity will remain available becomes widespread. History suggests that this belief is often misplaced. When conditions change, psychology shifts faster than fundamentals. Confidence erodes quickly. Narratives lose credibility. Participants reassess assumptions simultaneously. This transition is rarely orderly. As beliefs change, behavior follows. Investors who once embraced risk seek protection. Assets that were accumulated slowly are sold quickly. Loss aversion intensifies this process. Losses feel more painful than equivalent. Gains feel rewarding. This asymmetry causes participants to react strongly to declines, even if fundamentals remain intact. The result is amplification. Price movements exceed changes in underlying value. Volatility rises. Liquidity retreats. Importantly, these dynamics do not require panic in the traditional sense. They can unfold through rational responses to perceived risk. When participants recognize that expectations may not be met, reducing exposure becomes logical. The problem arises when many participants reach this conclusion simultaneously. Collective action overwhelms market structure. Late cycle environments are particularly vulnerable to this effect because positioning is often crowded. Capital concentrates in assets perceived as safe or essential. When those assets falter, the impact is disproportionate. Another psychological feature of late cycles is recency bias. Recent experiences are weighted more heavily than distant history. Long periods of stability lead participants to assume stability will persist. This bias explains why warnings based on historical patterns are often dismissed. Past crises feel abstract. Present conditions feel concrete. Recency bias also affects risk models. Volatility estimates based on recent data understate potential future volatility. Risk appears lower than it truly is. When volatility returns, models adjust abruptly. Risk limits are breached. Positions are reduced mechanically. This mechanical response compounds psychological reactions. What begins as reassessment becomes acceleration. Social dynamics further intensify this process. Investors observe others reducing exposure and follow suit. The fear of being last to act becomes stronger than the fear of acting prematurely. This is how orderly markets become disorderly. The role of narratives during this transition is critical. As confidence erodes, dominant stories fracture. Competing explanations emerge. Uncertainty rises. Markets dislike uncertainty more than bad news. When outcomes are unclear, risk premiums expand. This expansion does not require catastrophic data. It requires ambiguity. Late in cycles, ambiguity increases naturally. Growth slows. Margins compress. Policy responses become constrained. The range of plausible outcomes widens. This widening creates discomfort. Participants who thrived under clarity struggle under uncertainty. Another factor is the interaction between psychology and leverage. Leverage magnifies both gains and losses. In optimistic environments, leverage feels safe. In uncertain environments, it feels dangerous. As perceptions shift, leverage becomes a liability. Reducing it becomes a priority. Deleveraging is inherently destabilizing. Selling assets to reduce exposure pushes prices lower, which increases leverage ratios, forcing further selling. This feedback loop explains why declines can accelerate rapidly once they begin. It is important to note that psychology does not operate independently of structure. Market design, regulation, and technology influence how behavior translates into price movement. Modern markets are fast. Information travels instantly. Orders are executed algorithmically. This speed compresses adjustment periods. What once unfolded over months can now occur in days. This compression leaves little time for reflection. Decisions are made under pressure. Errors propagate quickly. Late cycle psychology combined with high-speed markets creates environments where transitions are abrupt. This does not imply inevitability. It implies sensitivity. Sensitive systems respond strongly to stimuli. Late in cycles, even modest shocks can produce large responses. These shocks can take many forms. Economic data disappointments, policy surprises, geopolitical events, financial accidents. The specific trigger matters less than the context in which it occurs. History shows that when confidence is high and buffers are thin, triggers have leverage. Once transitions begin, markets search for new equilibrium. Prices adjust to reflect uncertainty. Volatility remains elevated. Correlations shift. During these phases, narratives evolve again. Fear replaces optimism. Protection replaces participation. Eventually, excess is reduced. Leverage declines. Valuations normalize. Confidence resets. This process can take time. It is often uncomfortable, but it restores balance. Understanding this cycle is not about avoiding markets. It is about respecting uncertainty. The most successful participants over time are not those who predict every turning point. They are those who recognize when risk is underpriced and adjust behavior accordingly. Preparation matters more than precision. History does not reward those who assume stability is permanent. It rewards those who acknowledge limits. Every major market cycle has followed this arc: expansion, confidence, complacency, reassessment, adjustment. The pattern has appeared before every major market crash, not as a guarantee of collapse, but as a warning of vulnerability. Recognizing the pattern does not mean expecting immediate disaster. It means understanding that conditions have changed. Markets can continue to rise even as vulnerability increases. But when adjustment comes, outcomes are shaped by preparation. Awareness provides flexibility. Flexibility reduces fragility. As this cycle continues to evolve, signals will become clearer, not through dramatic headlines, but through subtle shifts in behavior. Participation will change, liquidity will thin, tolerance will decline. Those paying attention will notice. Those relying on narratives may not. History suggests that the most important moments are rarely obvious when they occur. They are recognized later, in hindsight. By then, outcomes are already determined. The purpose of studying patterns is not to predict the future. It is to understand risk. And risk, more than return, determines long-term outcomes. Every major market crash was preceded by confidence, not fear, by calm, not panic, by certainty, not doubt. That pattern has appeared before, and history suggests it appears again when conditions align.